Let's do it. We can do that.
All right. Hey, Steve.
Hey, Brett, you're wearing a stocking cap today.
You know why?
Why?
So I had to go to this event this morning, this in-person event in downtown Fort Worth, where it's addressed to business owners. And there was an Economist there, and there was Larry North, the founder of like all those gyms, and he's now a private equity guy and all that stuff. And so I didn't wear a hat. And when I got in the studio today, I was like, oh man, I forgot a hat. My hair looks awful.
I was going to say, you're not bald under there, are you?
Not that I
didn't
know
shave
of.
your hair at this thing.
No, but this was the only hat that was in the studio. So I turned down the AC and put this hat on because I'm embarrassed of my hair.
I'm sorry. Sorry to hear that.
It's all right. It's just, you get older and it stops being what you want it to be. Not for everyone, but for me. I just don't have the hair I want anymore.
Well, that's just sort of like getting older problems. It's going to be something.
Yeah.
Something starts giving out.
If that's as bad as it gets, I'll be okay.
I know, right?
Well,
like major organs, check.
Yeah. Yeah, no kidding.
Let's start with that.
Yeah.
We're good there? All right.
Yeah, at least you got to hold out long enough for them to come up with the next medical innovation to just like grow like your liver from a pig or something.
Yeah. Of course, and then you might just like jump to the end where it's just like they're just like sticking your brain in a jar. What was the thing on The Simpsons where it's just like, great, you don't need any of that. You just need your brain. So
yeah.
And have like, the Brett Star 5000 robot. So,
man,
just your brain in a jar.
Versions. Anyway, we got to talk about the economy. We have to talk about the economy. We talked a little bit about it last week, but I really just want to take a dive into it because there's so many things going on. First of all, I want to give a shout out to Brandon Giella, who released his new newsletter, which is now. There's like 3 jewels in the crown of great newsletters that are going out every week. Yeah. There's the Work Tech Weekly, which is the one that you write and distribute, and there's the Work Leader Weekly, and then there's the Work Fund Weekly. It's called the Work Fund Weekly?
Work Fund Monthly.
Work Fund Monthly. Okay.
Yeah, so it's once a month as opposed to every week.
Well, I can see why. I mean, it was pretty dense, really good analysis, financial analysis. I don't think that's the kind of thing you just spit out every week. It's pretty intense.
No, he did a great job on that. I was blown away by Brandon's analysis. It was just fantastic.
Really, really great. And one of the things in that newsletter, which you can subscribe to at thestarconspiracy.com, just hit subscribe, and then you can choose the things that you want to sign up for. I thought he did a really good job of juxtaposing what people's perceptions are of the economy versus what the fundamental reality in some ways is within work tech.
Yeah.
You just can't ignore the fact that it seems like this week that there's really a fever pitch around predicting recessions, predicting layoff, predicting all these near cataclysmic kind of financial event. So what's your view on what's going on in the economy?
Well, I mean, it's kind of, it's really paradoxical because on the one hand, unemployment is at like all-time historic lows, which, that's, some part of the fundamental reality that's driving the growth of work tech and the investment in work tech. And so that hasn't changed. Long story short is there is not only a dearth of talent, so for, in-demand skills, there's not enough software developers. There's not enough, sales and marketing people. You imagine any number of key roles, there's just not enough of them. Combined with there is a mismatch in skills. The skills that companies are going to need, today, 3 years from now, 5 years from now, are very different than the available skills on the market. And so there's a great need for reskilling. So all of that should be framed up with opportunity, but there's just this sourness in the market because people are pissed off after 2 years of COVID. They're tired of being stuck at home. They're like, hey, great, let's redo the garden. Well, you can't redo the garden because there's a year-long, wait if you want to put in a swimming pool, which has happened to people I know. Or, okay, great, so I'm going to remodel my house. Fantastic. We can get to your kitchen next year. So it's just like, it's people used to having things available on demand that, we've never had to kind of grapple with this thing of like, what do you mean I can't get fill in the blank right now? I've got to wait. What the fuck's that about? So I think that's contributed to the sourness. And then, specific to technology, looking at the NASDAQ going in the tank last Friday. So it's just like, April ended up, there was a 4% drop on Friday in the NASDAQ composite index. Is down something like 13% for the month and then down 21% for the year. So it's just like we've gotten used to over the past decade, stock market going up, and up. And now, tech stocks are finally really feeling it. So I think that's, specific to our industry, that's driving maybe a sense of hesitation amongst people of, hey, is this bad? Is this going to get bad? And so, I've got a lot of thoughts on that too, but let me stop monologuing for a minute and open it up to you. What in there, did I touch a nerve?
Well, I think you brought up a lot of interesting things. So I just, happened to be at this thing this morning, and there was a, pretty famous economist speaking who I can't mention. So we can't mention who spoke at this event.
Super secret economist.
I know, right? Well, he's not a secret economist, but for some reason, you just can't. Well, anyway, very well-known economist, and pointed to a lot of the factors that you're pointing to. The first of which there is that unemployment is very low, but there's a 5 million jobs gap, meaning that there are 5 million positions that need to be filled and no one to fill them. And that's like the largest gap that's, ever existed. So that would, show that there's a lot of strength in the economy, but it also shows, kind of the other side, which is why companies can't make as much progress as they need to because of all the people they need to hire that they just can't hire because they can't find them. So there's some interesting mixed signals there, but this particular person had a pretty counter optimistic view of what's going on right now. So first of all, he talked about the GDP contraction in the first quarter. And he basically said, this is what happened. He broke out, like what people look at when they look at, inflation and GDP and like all the different factors. And with GDP in particular, consumer spending was actually really strong. The thing that drove down GDP was business spending. And the way this economist described it was that, Q4 was a really big quarter and people were overcoming supply chain issues. So they went out and acquired tons of inventory. At the same time, there was this big pent up demand that occurred over the last 2 years. So people's savings went way up, a more significant peak than at any point in history of like how much money people saved. And at the same time that peak was going up, of course, consumer spending was going down, right? And so there was this huge gap of people who had a lot of money and they weren't really spending it. I mean, you can still buy stuff on Amazon, stuff like that, but you're not taking trips, you're not, engaged in all these other activities. When we get into the fourth quarter, basically people start spending again, but not enough to deplete inventories. And so when the savings were, not exhausted, but were, greatly contracted, and when consumer spending slowed down a little bit because a lot of the pent up demand had been served, here we are with, companies still holding inventory and a quarter of, down business spending, but consumer spending still solid. So he believes, in short, too late, sorry. He believes that we're going to see significant growth in the second quarter. And that we're not facing as many headwinds as people think, because if you look at where the inflation is, if you look at where the loss in GDP is, it's not conforming to patterns that would be predictive of like a huge meltdown or recession or whatever. And he also said, last two things, number one, that he believes inflation has peaked. And the second thing that he said was that interest rates will not go up as high as people expect. And so the Fed, trying to control the economy is not going to be as severe as people believe, because, it'll be raised a half point this week. It'll be raised a half point next month, or, 5 points, a half percentage. And then after that, he thinks things are going to start to bounce back into shape a lot more quickly than people expect. And so he's got a fairly rosy outlook. Oh, and one more thing. He was looking at the volatility index from the Chicago Stock Exchange, and basically pointing to times when the volatility index went above 30, which is just a handful of times in history. And within the first quarter after hitting that, there's a significant loss in like S&P performance and stuff like that. But if you look at 3 quarters after a spike in volatility like this, on average, the increase in shareholder value through stock exchanges goes up about 20 to 30%. So, that was a welcome and rosy picture for what we're experiencing. Thoughts?
Hey, I'll take it.
Now that I've monologued.
Let's bring this then around to kind of the work tech conversation, because there is what people are seeing and what they're feeling, and then there's kind of like the reality of what's kind of going on underneath the surface. So it's just like when you look at kind of like everything you were just talking about, bring it into kind of like what you're seeing, sort of like what's driving that contraction in the NASDAQ. Well, it's just like when you start looking broadly at, kind of the tech sector, it's just like, okay, so Facebook Meta, just like they had decent earnings, but they had a very bleak outlook for the future. Amazon had its worst stock day in 15 years and lost something like $200 billion in market cap. Netflix saw a contraction in subscribers again and saw their stock price tank 58%. And then, even Google stock went down after a weaker than expected earnings report. So it's just like you're seeing like some of the bellwether stocks in tech really kind of take it on the chin. But when you really start to look at what's going on, within work tech, look at what happened with ServiceNow. It's just like they almost melted the stock exchange with their earnings report. And it's just like there's a lot of upside on that stock. ADP had a good earnings report. They've just turned into a dividend machine. There's a lot of interesting stuff going on with Salesforce specific to kind of their work tech stack of, Slack and, MuleSoft and Tableau and some of the things that they're doing. And so there's a lot more good news, it seems to me, kind of within work tech that is being obscured by, some of the marquee brands within tech in my read.
Yeah, absolutely. And, the reality is that all of the factors that I just described were fairly insulated from that in work tech at this particular moment. They didn't see a slowdown in pent-up demand. Pent-up demand is still unfurling. And growth rates are, up across the board in all categories in work tech. I should say most categories in work tech. But there seems to be this, you can't deny that there's a growing sense of unease in work tech from work tech executives and relative to their outlook for, the future of, 2022 and beyond, where it just feels like, despite the fact that, there's all these, positive signs to the contrary, that we're, standing at the front edge of, something significant and negative happening. And I've got a theory on that, but it is remarkable that this anxiety has kind of, penetrated a market that's not in a bubble, that is, extremely healthy in terms of, people buying stuff, people making stuff, people investing in companies that are making the stuff that people buy. I mean, it's a very vibrant system. But, my view is that, there's so much that we don't think about in terms of how people's attitudes, behaviors, and beliefs are shaped during moments like this. And a lot of it's just trickle down. When a big tech company misses their earnings and, gets hammered in the stock market, there's this cascading impact. And, one of those impacts is that people start to sour on tech. And when I talk about people in that context, I mean institutional investors who are investing, our 401ks and, all that stuff. And they're not going in and picking stocks, independent of one another. Typically in that scenario, they're picking baskets of stocks. And so you're not going to see a work tech basket. You're going to see a tech basket, and there may be a work tech, company in there or not, but it moves the whole market regardless of, individual performance, within specific companies. And then it just starts to cascade from there. So you get the venture capitalists and the private equity companies. You have portfolios of technology companies, and 90% of their portfolio might be, experiencing some impact. And they just tend to pass along that, the same governance advice to work tech companies that are doing pretty well because of what they're seeing in the rest of their portfolio. And it just keeps going and going and going and spreading out, all based on, basically the fallacy of generalization. Tech, I think, has become way too diverse to just sweep up into one label that, that is fully represented by the NASDAQ or fully represented by, whatever people's perception is of, what the tech sector is. I think it's, tech is almost like, pervasive now, so that it would need to be split up into, kind of multiple baskets. I don't know. What do you think?
Yeah, I totally agree with that. I think that, there's also a couple of other factors that are sort of at play when you think about, and this is going back, over a decade now, that, tech broadly as a market has been overvalued. When you look at, market capitalizations, you look at, investment multiples, by whatever measure you're looking at it. I mean, we've known this for a while, that tech companies are overvalued. You're starting to see some of the impact of that with some of the, newly public companies, the last 2 or 3 years, public companies that are having a little bit of difficulty. So UiPath being one of them, kind of in the, the low code, no code, RPA kind of part of work tech, overvalued and having a hard time living up to expectations. And so they, their stock has been struggling, had some high profile stories about that last week. So, there's that reality, but when you get into kind of looking at what's investment happening in right now within work tech, just with the deals that have closed, already, this is already the second best year in the history of work tech investing, and we're just barely into barely into May. So, we're on track to, this could be another, $30+ billion year for investment. The need for new solutions to the just sort of current workplace realities is still acute, and so that dynamic hasn't changed. And when you hear about this pessimism in the market, like, oh, we're headed toward a recession, and maybe tech companies should start hoarding cash, and maybe we need to lay off some people and all of that. That's a very different message than what we have been hearing in our conversations with both sales prospects and with clients. I took, a sales trip for the first time since the pandemic a couple of weeks ago, and it was interesting being in people's offices, having those conversations with people. And there was nary a note of pessimism. If anything, the good times are rolling. And, met with, one, client that is an industry leader in a category that shall remain nameless. But, they had a great year last year. They're a large company. They were up, over 30%. And already in Q1, up 25%. And so
on big numbers, on
lots of zeros numbers. Not these are not early stage. This is not an early stage company. They're looking to throw more money into, paid media and investing in brand and gaining awareness. And so they're certainly an example kind of on the high end, but I've not had a lot of pessimism come into conversations. I'm hearing a lot more founders and CEOs saying, how do I invest? Where do I invest? What can I do right now? More. So I'm having a lot more conversations about hitting the accelerator than I am about hitting the brakes, I guess is what I'm trying to say.
Yeah, maybe I just hang out with the wrong people. I don't know. I mean, I'm hearing a lot of optimism, and that's kind of like a self-selection process as well, right? Like,
yeah.
If we're talking to somebody who's a prospect or, someone we've worked with in the past, they're in that camp that, really sees this volatility as an opportunity. They're reading what they, actually see, which is increasing sales and increasing demand and all that stuff, and not getting sidetracked by, kind of what they're reading about the macro situation or what, advice they're getting. But there's a whole group of organizations out there that are, more playbook oriented. The headline for them is, we're headed towards a recession. So run the recession playbook, despite the fact that, it would be absolutely ludicrous, right now, to, basically compound the biggest challenge that companies face, which is, hiring people and keeping good people around. To compound that problem by laying off, good people that you have doesn't make sense to me. But,
right.
I think the point that, we've hit a million times in a million different conversations is that when there is a lot of volatility, it creates a lot of opportunity. So those people who are, looking to take advantage of, all the positive signs that they're seeing in the work tech field are going to do better than the peer set that is being cautious right now because of signals that are being thrown off and, kind of the macro, climate. And, you can see it in their offices. You can see it in conversations with them. The difference, it's like when you walk into an organization where the good times are rolling, and it's not because, the company that you're talking about, I believe, is privately held and profit oriented.
Yeah.
And so it's not like, they're just burning cash from investors or anything like that. It's just they're having a lot of success. Yeah. And you walk into another office where, they're contemplating layoffs or, running a conservative playbook pre-recession, and it just feels like all the oxygen's been sucked out of the room. So I think there are, some different groups there, but it does create a huge opportunity for people who, are looking to gain market share against competitors who are perhaps, being a little bit more cautious due to the uncertainty right now.
Yeah. I think, too, some of it is just the sort of the relentless, unprecedented bad news that we've lived with in the 2020s, going from global pandemic to largest land war in Europe since 1945 to fill in the blank of crazy headlines. And I think that's made people maybe a little more cautious than ordinary, simply because, if you're thinking about, black swan events, it seems like there's been a lot of black swans lately.
Yeah.
So, some of this is understandable.
Yeah. What a shitty decade. This is a shitty decade.
Yeah.
The 30s better be fucking awesome because the 20s are off to a bad start. I'm just saying. Yeah. There's a lot to be grateful for, a lot to be thankful for, but they're off to this decade's off to a terrible start. But I have to kind of press you on this a little bit because look, you do a bunch of financial analysis, we do a bunch of financial analysis as a company. We look at and predict growth in certain areas. We've been around for 20 years. People listen to us, and we take our responsibility very seriously in terms of what we recommend. But at the end of the day, the work that we're doing to understand market dynamics and growth and investment and all that stuff is all for a point, and that point is to be able to advise people in terms of strategy and customer experience and employee experience when they should how they should approach the current context. It's for something. It's not just to kind of report on what's going on in the market, but it's also to say, okay, based on this that's going on in the market, this is what you should be doing, client. And this is generally speaking, what people ought to look at in terms of what the opportunities and challenges are in any given market. And so if pushed, which I'm doing now, you're crunching all this, financial information all the time. You're talking to companies at the ground level. You're talking to individuals in those companies. You're also looking at the, macro numbers. What are people to make of this? I mean, what's the play here? What's your advice based on what, the steady drumbeat of information that you're exposed to?
Well, I mean, I think some of it depends on, what are you trying to accomplish? What stage are you at? The way we approach our work is some of it's data driven. What is it that we are actually seeing in terms of what dollars are following which trends? But then some of it is just aggregating conversations. So you think about like the Fed's Beige Book. What is the Beige Book? They're just talking to a bunch of business owners and they're trying to get an idea across sectors. What is the state of the economy at any given moment? Basically the stuff that doesn't show up on the scorecard. And so we do sort of the same thing, which is easy when you have, what do we have? 82, 83, 85 people, something like that now. And they're, talking to, half a dozen clients a day or a dozen sales prospects. And it's just like, we're able to aggregate a lot of conversational data that once you kind of know what to listen for, you start to hear some repeating trends. And so I think that right now, in my mind, the thing that most companies need to keep in mind that the underlying market fundamentals for work tech are still good. The problems that businesses globally are experiencing that are driving investment in this industry have not changed for all the things that we listed earlier. Those fundamentals aren't going to change. So if you are, running a company, you've got product market fit, you have capital in the bank. It's just keep running your playbook. I think that for earlier stage companies or companies that need to go into sort of fundraising conversations, the dynamics are a little bit more challenging simply because the fundraising environment has gotten more difficult. It's just investors have gotten more conservative. They're taking a closer look at, basically what are the assumptions that are underlying your business plan, and they're driving a harder bargain. And so right now it's, money has been easy the past couple of years. It's just investors have been just throwing money at companies. That's changing a little bit now. So for early stage companies, it is a bit more of a challenging environment. But at the end of the day, it's just like, I think that it is about being able to tell a good story, whether you're talking about for an investor or for a buyer, about how your business is skating to where the puck is going, essentially. Yeah. And I just got an email before this meeting was from a early stage company founder, and it was a really good investor pitch deck. We see a lot of them; most of them are terrible. This one was really good for lots of reasons. But the big takeaway was, the thing that this company is building is very much, 3 to 5 years from now, going to be, a very key trend within the industry. We're already seeing it begin to emerge. Being not, we've talked about this a lot over the years. It's just like, being visionary is really tricky, because if you're too visionary, you're the guy in the tinfoil hat that looks like a kook. What you want to be is just a little bit ahead of the market, and we're seeing a number of good ideas that are the right amount of just ahead of the market that they'll be able to catch the wave. So I think that really a lot of it just depends on where you're at in your growth journey.
Well, I think that, there's two really great points that, I want to double click on. The first is just overall performance. So we've got tons of clients, probably over 100 active, and, probably over 1,000, going back 20 years.
Yeah.
And in addition to that, we're also talking to people who are not clients all the time, and researching companies, or doing analyst briefings, or selling to them, or, whatever. And tell me if you agree with this, but most of the organizations that I'm talking to are experiencing success, and the ones who are not, it's because it's problems of their own making, and they would readily admit that. It was an acquisition that went wrong, a merger that was sloppy, bad business decisions in retrospect during the pandemic, et cetera. But the friction in terms of being able to perform well doesn't seem to be there. Like, if you can execute your plan and not have, unforeseen, problems like the ones I just mentioned, then, chances are you're either doing good or you're doing great. And everyone else who's not, it's, not because of some macroeconomic situation. It's because of, some situation that's unique to them. Is that similar to your conversations?
Yeah, very much so. And you're right. We do have a little bit of selection bias, because we talk to more good companies than shitty companies.
Yeah,
and so it's just like we're definitely seeing a segment of the market, but I think that there's a lot of good companies within work tech broadly, and there's certainly been a lot of growth when you think about what was the size of the market, even 5 years ago, not to mention 10. It's just like it was a much smaller, slower growing, more understandable market. Things are just growing so fast, and things have gotten so big. There's a ton of companies out there.
Yeah. So, the first point that just speaks to the underlying, quality of the work tech market right now is that most companies are doing just fine, or they're doing great. And I think that's true even with our selection bias, because there's other companies that we don't talk to that we know are doing great, et cetera. But, you mentioned something else, which is, where are the investment dollars going? And I'll tell you from my experience, there have been times in the work tech market where it was really frothy in terms of the kinds of companies that were getting investment, and the bets that were being made. I think about the AI period, for instance, where, a lot of these companies that got a tremendous amount of funding weren't really focused on any, specific solution. They were just focused on, kind of AI as their primary value proposition. And, a lot of cases that didn't seem grounded in, either the reality of what organizations needed, nor the trajectory of where it seemed technology was going, and the, kind of growth curve of people's ability to accept, technology at various stages. Not everyone's going to go out and adopt something that's 15 years, down the road, and may or may not actually end up being on trend or not. And I've seen a lot of that stuff in the past. I don't see that right now. The companies that are getting investment are like right, down the middle of the plate, companies in line with trends and, evolutionary advances and some pretty significant innovations that are all core to business challenges that people feel acutely right now. And so I don't see a lot of like crazy investment going into crazy, kind of idea only companies without a really specific, compelling, business case that is, necessary right now. Seems just like a higher quality, kind of focus in terms of investment.
Yeah, and I think that, also just combined with the fact that there's just more problems, business has gotten more complex. I think that the shift to hybrid work, the focus on employee experience, I mean, it's so broad, and there's so much need out there that, and honestly, it's just like there's when you think about it from a buyer perspective, there are so many buyers that are in market that don't know what to buy, but they're asking tough questions. They're not, when you think about like the first generation of SaaS buyers and how they just got totally fleeced because they didn't know the questions to ask. And they ended up signing contracts with no idea about how this is going to get implemented, how is it going to be serviced, and just the terrible experience they have. It's just like we're, on what, third, fourth generation of SaaS buyers, and there's just a lot more experienced buyers out there. And even though we're in this time in the market where tech stacks are completely getting upended, buyers are asking tougher questions because they don't want to fuck this up. They know that they're making decisions that are going to guide the next 10 years of their companies. And so they are taking very, I think, generally speaking, very deliberate steps to try and get it right.
Yeah. And, I would just, kind of wrap up by saying, like, I believe this in my heart. I don't think there's ever been a better time to be an entrepreneur in work tech, because I don't think that there's ever been a time when there's been so many unsolved problems in the world of work. It's never been like this. It's never been like this where, like, some, especially larger companies struggle to just, complete the day-to-day stuff that, keeps the company moving forward. And at the same time, that's all against a backdrop of it being nearly impossible for people to maintain, a workforce with any continuity, because of the constant, hiring and, resignations and, all that stuff. And, when you look at those kind of, twin inputs of it being one of the most difficult times to run a business because of people, and then all of the new challenges that have been presented because of the changes brought about by the pandemic. Entrepreneurs in this, particular stretch of work tech are going to be creating things that set the model for the next 50 years. This is like our Drucker moment. This is like, calling a group of people knowledge workers, for the first time, and then talking about, organizational design and, how stuff's supposed to work and how to be effective. We've hewed to those same principles that, are passed to us from the 50s and the 60s and the 70s for decades. And now we live in a completely different world of work where a lot, if not most of the stuff that was business convention, about how companies are supposed to work and what your relationship is supposed to be like with employees, everything's on the table.
Yeah, and it reminds me of that. I think it's a Bill Gates quote. People overestimate how much things will change in the short term and underestimate how much they'll change in the long term. I think we're kind of in the middle of that right now. When you go back to back to the turn of the century and the SaaS market, a lot of what's happened in technology since, say, 1995 in enterprise technology, say 95 to even like 2015, 2016, was just, automating the same old shitty processes that had always existed in the workplace. If you think about like when I came into the workplace in the early 1990s, the workplace was not that much different than it was in, say, 1950 in a lot of ways. There might be more. There was fax machines and, some computer technology, but the way that businesses worked, the way the workplace worked was very much the same, very traditional, hierarchical. People wore suits, all that stuff. And that didn't really change that much between, 1990 and really the great financial crisis. I think that, since then we started to see that sort of move from automation give way to innovation, and now we're in a period of the market where it seems like it's just all innovation, and certainly some of that innovation is going to, catch and stick, and some of it's not. There's a lot of technology now that has potential, but a handful of these companies are going to be the great brands of the rest of the century. And some of them are going to just be acquired, rolled up, or be historic footnotes. And so it is a very interesting segment or time in the market because there is so much that is changing now. And I think that in some ways we are overstating how much it's going to change. between now and 24, 25. But I think when you think about how much business is going to change by 2030, I think it would shock us how much it is going to change. And we're right in the middle of the experiment right now.
Well, and that's the other side of the coin that we're talking about, right? Where the growth is great and people are buying, and there's so many opportunities because there's so many things that aren't working at work, and we're facing a very acute labor shortage, et cetera. And that can be great for work tech, but the other side of it is that it's also the biggest period of solution switching that we've ever seen. As you said, tech stacks are being upended. And for every, for most, not every, but for most new deals, there's a deal that went away for somebody, right?
Yeah.
And so, my advice on that point, and we've seen a little bit of this before, but nothing like we're seeing now. My advice on that particular point is that innovation is not, optional right now. And so if you think you're going to get by, with an old solution that hews to old principles that, is a little kludgy and has a lot of tech debt, et cetera, the reality is that's just not going to fly. And that's an immediate impact because people are flying away from what they perceive as low quality employee experiences and customer experiences, engaged with solutions. And they're moving towards things that look light years ahead of all of the solutions that a lot of people now perceive to be part of the problem.
Well, I mean, and you bring up an interesting point because it's just like in enterprise software, especially when you're looking at kind of the enterprise class segment, there are not too many categories that you're not displacing a vendor. You're having to go in, probably an RFP, long sales cycle, hand-to-hand combat. I mean, you're really having to go at it to win a logo. But then when you go down into the mid-market and the SMB, there's still a lot of greenfield opportunity. And I mean, that was another, kind of takeaway that I've had over the last month, both, kind of doing visits to companies and also just having a lot of conversations on Zoom conferences and things like that, is there's still a lot of opportunity in mid-market where companies are going in, they're not displacing a vendor, they're replacing an analog process, paper or a spreadsheet. And there's still a lot of just innovation that we're seeing going on in the market where it's just like, we can sell, fill in the blank solution, and we're not going up against a competitor. We just need to get connected with customers faster. And so that's sort of the one of the things that it's easy for market watchers that are focused on kind of the large enterprise segment to get caught up in, which big logo won this deal or that, or who lost, a big logo. And there's, really most of the market is still not a replacement market if you think about it in whole, if that makes sense.
Yeah, it absolutely does. And I would also add that, the folks who are eventually going to pay the bill for all of this switching and innovation are going to be Oracle and SAP and IBM and, all the really big, software and tech companies. And they're going to pay the bill because when people are switching away from solutions that don't hew to the new organizing principle, whatever that organizing principle is, they're typically switching away from big company, big brand stuff and looking for things that are more innovative and et cetera. I said innovative in a strange way. Sorry. And those companies that people switch to eventually end up growing significantly. And then SAP and Oracle will come back and buy them later and buy their way, kind of into that innovation. But you also see it in the mid-market. A lot of these companies who go into blue ocean categories and they're not switching people away from stuff, they accumulate a lot of success at the mid-market, like Salesforce.com, and then they move up into the enterprise market and they become a secondary threat over time to the same, kind of big, large footprint software providers. And so this is that period where, I believe that you're probably going to see some significant headwinds for the larger organizations who are slower to innovate. And then, as the market matures, they'll kind of step back in and drive a lot of very large, acquisitions down the road to buy their way back into, whatever the innovation trends are after they've settled in. So I think it's going to be, in short, all of that adds up to a period of extreme innovation and volatility in terms of people just switching their tech stacks. And I've never seen churn like this, even in companies that are growing, 30, 40, 50%. They still have higher churn than they would have had, 3 years ago. Because everybody, was just, switching everything. And in some cases they're trying to put together, kind of more integrated, kind of suite approaches. In some cases they're just trying to drive towards different organizational goals, or, they want more innovation injected in, a certain aspect of their employee experience or whatever. And so I think the big companies are going to have a big debt to pay over the next few years.
Yeah. And I think some of that goes back to this shift toward everything is about the experience, whether you're talking about what is the user experience, what is the customer experience, what is the employee experience. And, vast oversimplification, the big logos are saddled with enough, legacy product and tech debt that they can't innovate fast enough to keep up with the changes in the market, but also just servicing the experience that buyers want and are demanding. So I think they're going to try. You saw that with Oracle launching their answer to the employee experience platform. They've done some interesting things with Fusion HCM, but at the end of the day, it's just like, Oracle is a large, complex, slow-moving company that it just seems like culturally, they're going to be hard pressed to keep up with the pace of innovation. And that could be said for any number of large legacy tech brands.
Yeah. And to put that in perspective and bring it full circle to the beginning of our conversation, if you have a big complex organization and you're trying to catch up, from a user experience perspective or whatever, trying to keep, a pace with the rate of innovation right now, it's really hard to do that if you can't retain your people or hire people.
Yeah.
And, I don't feel like a lot of the larger organizations are capable of providing because of their own, structures and the way that they've approached employee experience in the past. I don't think they can compete with smaller, more innovative organizations on employee experience. And that's going to be a big catch up. Yeah.
And I think that's going to be really interesting because we're seeing that play out in real time, where even like some of the, the near term or more recent employee experience marquee brands like, the Google, the Google, Facebook. I mean, like a lot of the companies that were like, this is a company you want to go to work for, they're getting killed in terms of their employment brand. And I mean, even when you get into looking at some of the big companies in financial services, some of the real heavy hitters, companies that have been able to really kind of pick and choose their talent are not in that position anymore because of this shift to the hybrid workplace. And there is, I think, the entire, talent market that has sort of been presumed pre-2020 is going to be completely upended, which is going to present opportunities, innovative, scrappy companies that can field a better employee experience are poised to acquire the type of talent that can drive the innovation, that can drive category leadership, essentially.
Yeah, and I think it's a moment of truth. I mean, I think a question that a lot of people have to ask themselves right now, the very large companies, is does their actual employee experience live up to the quality of their advertising about their employer brand?
Yeah.
Because there's a huge gap. If you've never worked at Amazon, for instance, and you see all these great ads on television and, it looks like they're super, employee focused and all that stuff. And then you go work in a warehouse. and the jarring discontinuity between your actual work experience and what it looked like on TV becomes one of the things that rubs salt into the wound.
Yeah.
And, can result in a really, kind of negative outcome. And, again, this is a selling platform for work tech. How big is that gap in employee experience between, what the assumption is or the brand is for working in a company and the actual experience, and what impact is that having on turnover, because people have to live up to the promises that they're making from an employer branding perspective, or they're just going to hemorrhage people for years to come. I mean, this labor shortage is not going away anytime soon.
No, it's just going to get worse. And I think that it's going to also have the ancillary benefit of driving automation and making automation more accessible faster. So whether you're talking about, hey, great, I just bought a hamburger from a robot, to a drone just, delivered some toilet paper to me, to, hey, an AI bot just wrote this story for me. I think that you're going to see it manifest itself in any number of ways, which, to bring this back to where we got into this conversation, are you bullish or bearish on the economy? I mean, that's probably asking the wrong question. It's just like, it's just like all politics is local, all economics is local. Mm-hmm. Where we work, when you look at all of the things that we just sort of unpacked, I'm incredibly optimistic about the prospects for this industry over the next decade. And, is there a bad month or a down quarter? Yeah, maybe. I mean, there can be some choppy waters, but I think that it's a hiccup in a long growth period at the end of the day. And so I'm incredibly optimistic.
Yeah, I'm bullish on both, actually. I think that both the macro economy is going to, perform a lot better than people think in 2022 and probably beyond. But I'm extremely bullish about work tech and what the next 10 years of work tech look like. Because, I mean, there's been too large of an investment in, innovative new companies coming to market that, it's just too large to not continue to create innovation in the market and drive switching and buying. And, there will be new leaders, and there will be people who, companies that blink out of existence or are greatly diminished. But, it is a period of extreme volatility, especially emotionally. There's a lot of emotional volatility. But, I think when we're looking back, 5 years from now, this is going to look like a really, historic and strong period in work tech.
Yeah. And I think that, one thing that we've learned, over the years in this industry is just like the periods when everyone else is inclined to hesitate are when you need to get hustling, because that's when the opportunity is presenting itself.
Even a quarter of hesitation right now, that's like the new year, it's like the quarter is the new year. A quarter of hesitation will set you behind because of how fast the market's moving right now.
Yeah.
Cool, man. Well, as always, it was good catching up with you. Enjoyed our conversation.
Good talking to you. Love the hat.
Let's not talk about the economy next week. How about that?
All right. Challenge accepted.
Yeah. I want to move on from the economy for at least like 3 weeks, and we can kind of come back and roll the tape and see how we feel a month from now.
I'm good with that.
All right, man. Talk to you.
Okay.